Do you want to know what the hell is going on in the stock market? Do you want to know why all of a sudden inflation is falling and the Fed is still being a little bee? Do you want to know why I'm not effing leaving and why I'm actually wearing the rocket ship emoji? It's because of the ship. The BullShip. The actual like pirate ship. Yeah, I know that sounds insane, but it's the easiest analogy and the best analogy I could think of to help you understand what is going on. So we're going to draw the ship. After I draw the ship, I'm going to explain 3 very important things about the Federal Reserve to you. They are critical, and I'm going to show you some charts that are very important. But first, I am going to draw you a pirate ship. All right. Here you go. Get the little crow's nest up here, and we'll have a little flag. Okay? All right. Why did I do this? Well, it's because right here, you have Jerome Powell, okay? He's up here in the crow's nest being like, oh, damn, inflationary problems. Jerome Powell is driving the ship of the economy. And every single time we get bad news, what I want you to think of is a crate of bad news being loaded onto the ship. What Jerome Powell is trying to do is load on as much bad news as possible on the ship without sinking the ship. And he is doing that to try to get inflation out of the economy. What I want you to know, though, is this piling on of bad news, like producer price inflation data yesterday, which came in terribly low. Huge misses on the producer price inflation data. Huge revisions down on the producer price inflation data for the prior release. And retail sales data coming in so bad that all of a sudden we're like, this is great. Oh, wait, no, this is bad. That was basically the market's reaction yesterday, right? Because the market for an entire year has been saying, Kevin, we need inflation to come down. We need retail sales to come down because that'll lower pricing power at companies and that'll reduce the pressure on inflation. Well, that's what we got yesterday. We put more bad news on the ship, which is really good for inflation coming down. But guess what people are worried about now? Now people are like, but wait a minute. Jerome Powell isn't U-turning. Why is he not U-turning? The water is starting to get really close to the edge of the ship because the more bad news we put on, the more the ship comes lower and the more the water is starting to splash over the edge. And what we're getting now is people realizing at first, yay, we have crates of bad news. Let's call it food for the ship. Yay, we get to survive longer on the ship. Great, inflation's coming down. But, oh, it's getting really heavy on the ship with bad news. Water is potentially starting to spill over. And so everybody's looking up at Jay Powell going, bro, starting to get wet down here. What the F, bro? And Jay Powell's like, must get inflation down. Load more food onto the ship. And people are like, dude, we're going to start sinking, man. Jay Powell, do something. Must get inflation down. And so people are like, dude, this guy's blind. He's up in his ivory tower. He's blind about what's happening down here. But he's not. He knows exactly what he's doing. And that is what I'm going to explain to you in this video. He is playing the psychological fiddle. He is mastering psychology right now. And you must know what he is doing so that you could properly position yourself in the moment. This is literally why what I'm about to explain is an example of why I have a program called Stocks and Psychology of Money. Because there are wild things when it comes to investing. And I have found that the best bets are made when it is psychologically difficult. When everybody is telling you you're an idiot, that's when some of the best bets are made. But what I want you to know is the expectations play that Jerome Powell is making. The psychological play. And it's all defined by this chart here. which I will remove myself from this chart as soon as I remind you that on the 30th of January, in just 11 days, lifetime access to the programs on building your wealth at this price will be going away because the price will have a substantial change. The coupons will be going away. We're going to something totally different. And you have a at least 3-month price guarantee that you're getting the best price ever for the next 3 months if you join here in this January. Now, I also have another big piece of news. I think starting 5:15 a.m. tomorrow or Monday, depending on when my coax cable comes in, course members have voted on this, and it's good for the public too. Starting at 5:15-ish, we're thinking about doing from 5:15 California time to 6, live stream where I cover CNBC, Bloomberg, news articles, and just kind of like, we just wake up and have coffee together and kind of get a feel for what the market's doing in the morning. And we'll start the course member live stream at 6 a.m. and do the bell together in the course live. But the public will get that for free. But anyway, this is the chart right here, folks. This is the chart of inflation expectations, okay? And there are a few things I want you to know about this. So this is called the 5-year break-even chart, and it tells you what inflation expectations are. The way it works is it basically takes the difference between inflation-protected treasuries and non-inflation protected treasuries. You don't have to know what that means, okay? I don't want to overwhelm you. We're confused here, and I'm not saying you're not smart enough to understand it. I know you are, but I'm saying it doesn't matter, okay? What I want you to know is this matters, is that finally we broke a new low over here. Not by much, though. This low right here is 216. This is 215. But for the first time ever, yesterday, we actually broke the low on inflation break-evens. Now, you might be thinking to yourself, who cares? Well, Jerome Powell does. Because remember what I said. He is playing with our psychology. If Jerome Powell came out yesterday and said, great news, y'all have loaded enough bad news on this ship, we could stop putting bad news on. What do you think everyone would do? Everyone would start having a party, break open the boxes, start drinking, start eating, and it would effectively, okay, I'm not playing science here, but inflate the ship, so to speak. Okay, I'm trying to get the best analogy I can to make this simple here. In like actual stock market terms, what would that do? As soon as Jerome Powell comes out and says, good job, everyone, we have succeeded at conquering inflation, what do you think you're going to do? What do you think every CEO in America is going to do? It's literally what was projected yesterday by Morgan Stanley. Okay, I'll pull that up. But what do you think your grandma's going to do? What is my daddy going to do on Robinhood again? What is everyone and their mom going to do the second Jerome Powell says, we have succeeded at conquering inflation? Everyone and their mommy is going to go YOLO stocks. Everyone's going to buy stocks like crazy. The stock market's going to double. It's faster than you could even say double in many stocks. This is like the Fed U-turn I'm pretending, right? Forecasting, so to speak. Fed says, hey, we've done enough, we could cut rates, right? Like when this time comes and the problems of the economy, the inflation is gone, everybody's going to go crazy. People are going to start taking debt again. They're going to start buying new computers. They'll buy new iPads. They'll go, I'm rich again in the stock market. They'll buy everything again. And then guess what happens? Then you recreate the monster of inflation. It's literally what Morgan Stanley basically started warning us about yesterday. Now, this is actually positive. But look at this. You have Morgan Stanley talking about CEOs getting more confidence in their economic outlook, that when the Fed pivots, we're going back to the glory days. I'm not going to read you all this, but that's basically what it says. This is actually good news because it actually tells you, even if we take some water onto the ships, the banks are very, very confident that this ship will not sink. So we might have to, start bailing out some water on the ship, but banks are extremely confident that we are not going to sink. So that's why you're getting so many people starting to try to pre-predict in the Fed U-turn. Now, a lot of people are like, but wait a minute, like Kevin, like this is bad news, right? The market sold off after PPI data came in. And I'm like, stop kidding yourself. We got rejected by the most simple trend line that everyone and their grandma and my 7-year-old can draw on the S&P 500. Big deal. we got rejected because we went over the 200-day moving average and we hit the hardest trend line that is literally over 1 year old. We got rejected off it. Big deal. We are still up from the bottom, right? So it's like, it's not that bad. And Jerome Powell knows that. Jerome Powell has a goal though, and I'm gonna show you exactly where that goal is right after I thank you for being here. Really appreciate it. I know you have choice in whom you're watching, and I really try my best to provide value. I want to be grateful because I wouldn't be able to do what we're doing here on the channel and growing with y'all if it weren't for you. So seriously, like, cheers. If I could meet you in person, like I met 2 subscribers yesterday in person, I'd cheers to you too. Even if you're Mormon and you just drink Diet Coke or regular Coke, I don't care. I'll cheers to that too. Okay, all right. This is Jerome Powell's map. So if you're like, okay, Kevin, he's driving a ship. You have like the stupidest analogy ever, but I get it. It makes sense. Oh my God. Sorry, I can't put stupid line on this. There we go. What's your point about this dumb chart? Here's my point. You saw how I said we broke the low, right? On the break evens because Jerome Powell is like, we must fight inflation, right? And now everybody's like, damn, he's serious about this. He's gonna keep loading more shit on this plane. Not the plane, sorry, the pirate ship. We're gonna start taking on water. Let me show you where he flips, okay? So I'm gonna take this all the way back to 2018. Jerome Powell flipped over here, right here. Here, I'll put a beautiful arrow there. In December of 2018 is when Jerome Powell flip-flopped. And in December of 2018, inflation expectations, where inflation wasn't actually really a problem, were about 1.5. I personally believe we must go under at least 1.6 or potentially lower before the Fed flip-flops. So at least under 1.6. Let's see here, Jan, Feb, March. This is about March of 2020 here. You can see this is the end of the quarter right here. So that's probably about March 23. This is about when the Fed U-turned the last time. So it's also possible that things have to break for the Fed to U-turn, but I actually don't think it has to get that bad. But we want this chart to go down. This, again, is a break-evens chart. And we are nowhere near yet the Fed U-turning. But, that doesn't mean you don't want to potentially be in stocks now, because a lot of people are like, Kevin, why don't I just wait to get into stocks? And I'm not trying to show you to get into stocks. I don't care what you do with your portfolio. It's not going to make a difference. So look at this downtrend. This downtrend is why we're off stock market lows, because the more this trends down, the more we know we're getting close to the U-turn. And this is literally the market pre-pricing in the bottom. That's why it's entirely possible that the S&P 500 and the NASDAQ have already bottomed, because this trend is moving down. As painful as it is in the short term to look up at JPOW and us going, bro, we're starting to sink over here, and him going, we must continue to fight inflation. It's scary because water's starting to come on the ship. But not only is water starting to come on the ship, you personally in your life are like, I'm getting sick. I'm getting scurvy. He's not letting me crack the box of the bananas. I'm not getting my vitamin C. I'm getting scurvy. And in like relative to our actual world, that is my business income's going down. I'm doing less deals as a real estate agent. I'm selling less product in my small business. Less people are coming to my restaurant. Retail sales are down. Shit, we might actually be going into a bad time. Well, duh. Duh, yes. We're going into a recession. The yield curve is the most inverted it's been since my chart doesn't actually go back any further. It's so inverted. And that tells you are going to take on water. That is what the inverted yield curve tells you. Is it screams at your face and it says, we are taking on water. And you are going to have to get off your ASS and work harder, because we need you to help bail out the crap storm that now we are going into. But that is the point. The Fed is using that fear of water coming into the ship to force inflation expectations down. And by forcing expectations down, he actually achieves killing inflation. Because again, everyone and their mommy will go buy a new boat or be an idiot and buy an airplane in a recession. Even though I think that was a great purchase. Okay? I don't need to justify that anymore. But anyway, if everybody does that, it's a big problem. But what do you have here? This is the inverted yield curve. We are the most inverted we have been at max. It's not as bad as the 80s. I know that, but I can't go back on the chart because, again, it's set to max right now. But we are more inverted on the yield curve right now than we were in the Great Recession or the dot-com bubble. And it's the re-steepening of the yield curve that tends to be painful, right? 2008 and 9 were the big painful ones. That was pain. Okay, that's the recession part where it's like, crap, my income's down. Okay, over here, crap, my income's down, during the dot-com bubble. Which does suggest, yes, there is going to be more pain going forward before we have good news. But a lot of people say the only reason it's this inverted is because the Fed is forcing a recession. As soon as the Fed U-turns, it's back to glory days. So ironically, that's why you have the stock market not at bottom, because people are pre-pricing in that the real potentially only pain is the Fed. Don't get me wrong. There could be structural issues. We might not see them yet. You could have a black swan event where all of a sudden something breaks and we get circuit breakers in the stock market again, and we actually hit our real stock market bottom. We get the real VIX spike, and then it forces the Fed U-turn, right? Because then the ship will start sinking. So, in fact, the sooner that happens, the better. The sooner that happens, the Fed U-turn happens. But you also need to make sure that inflation is down enough, because if you don't, and the Fed U-turns too soon, then you go back to problem number 2. Remember, I told you I'd tell you 3 problems about the Fed. The historic flip-flop. So you go back to the 70s and 80s. The Fed was start-stop with rate hikes and rate cuts. And that actually led inflation expectations in part to unanchor. Inflation expectations went up for multiple reasons, though, and that makes this comparison so difficult. People compare it to the 1970s and 80s and say, well, inflation expectations were unanchored. Yeah, well, no, duh. We left the gold standard. This was the first monetary experiment that we ever had with fiat. Of course, people thought we were going to become the Weimar Republic again because we'd never actually gone through an inflationary environment before and not seen currency collapse. So, of course, inflation expectations were high and unanchored. So, of course, we had to crush the market by raising interest rates to 18 to 20% and prove that, no, this experiment of paper money backed by nothing other than your trust led to substantial breakdowns in expectations. So, yes, and I say this full well and knowing that the words "this time is different" are very dangerous. Those are the 4 most dangerous words in investing. And I say that to you clearly because I want you to know we don't know if something could break and what could happen out of that. We don't know. But there are massive differences. The fact is, there are massive differences between now and then. We have inflation expectations plummeting. And now as long as inflation continues to break to the downside, sooner or later, the Fed will realize, okay, we've got enough bad data. Unfortunately, that's where the third problem comes in. We don't actually have enough bad data yet. And this is exemplified via things like the Beige Book. So let's look at the Beige Book today. So here's the Beige Book. See? It's beige. Okay, congratulations. You saw the Beige Book. Now, let me read you some boring stuff. Now, I'm actually just going to bottom line you, okay? So listen to this. 5 districts reported slight or modest increases in activity. 6 noted no changes or a slight decrease. 1 cited a significant decline. This is kind of like, I want you to think for a moment. Go back to that ship. So imagine at the front of the ship, you got 5 people going, hey, things still ain't that bad over here. Yeah, because you're at the bow, okay? You're not at the low part of the ship, jerk. And just for analogy's sake, okay? 6 are like, hey, it's starting to get a little wet over here. And 1's like, damn it, right? That's not enough pain yet. Jerome's up there in his crow's nest. I need everyone bitching. Sure, you got other parts of the ship starting to smell. You know, the potty's looking pretty bad. And right now, the potty's the housing market. It's getting worse. You've got, though, in the labor market, only one district reported a slight decline in employment. Need more pain. Look at the economic data that came out this morning. Jobless claims. It's not screaming massive pain to you yet. Jobless claims were expected to come in at 214,000. They came in at 190. That's good news for employment, but that's bad news for the Fed being, wanting to U-turn. It came in well higher than expectations, and continuing claims fell rather than rose. Some people say it's because of, obviously we know this, unemployment substantially lags a recession. Of course, everybody knows that. Actually, some people don't, but unemployment substantially lags, so this is a huge lagging indicator we're looking at. But the point is, go to the Beige Book, and again, hey, great. Manufacturers in many districts reported continued easing in freight costs and prices for commodities, including steel and lumber, though some remained elevated. So it's like, it's not all bad yet. Retailers noted increased difficulty in passing through cost increases. Jerome's like, good, put on your raincoat. I want you to get a little wet. I want you to feel a little pain, you little sugar boy. Suggesting greater price sensitivity on the part of consumers. Right? Sure. But then again, retail activity in 5 districts still improving. Housing market continued to cool in New York. Same thing in Boston. You have wage and price inflation continuing to subside, but growing at a modest pace. You've got employment growing modestly, but demand softening, but still healthy. Labor shortages still an issue in St. Louis. Construction and real estate sectors continuing to struggle. So you have a Beige Book that's starting to give you red flags. It's like, hey, we're starting to take on water down here. And he's like, I know, we must take more water on. That is the psychology. The more Jerome Powell sends us the signal that we are not wet enough yet, the more inflation expectations actually go down, because the more people on the ship actually start realizing this MFer is actually going to make us keep putting on more bad here, and he's actually going to make the water line go slightly above the ship to where this guy is actually that brazen that we might be steering a ship while taking on water to prove a point. Yes, exactly. He does not want the entire ship to be underwater, but he will make it so that the waves are cresting above this edge. And that will force inflation down, because the worst thing that could happen is that inflation ends up increasing again. Because if inflation goes up, it's going to be nearly impossible to get those 5-year break-even inflation rates to stay down. So what we have right now is actually good. I know I sound crazy to some degree saying that. And some people get pissed off at me because they're like, Kevin, you said negative retail sales were good news, but the stock market went down yesterday. And wait a minute. Why are you cheering for the demise of the economy? Like, that's what some people are saying. And it's like, look, we need to give Jerome Powell what he needs. We need to give him enough bad news to where the world realizes, crap, okay, yeah, maybe we do want to start saving a little bit of money. We drive inflation down, and we continue on the path of lowering expectations for inflation. If Jerome Powell gets off the crow's nest and goes, good job, guys, mission accomplished, PPI down, we all win. The ship's just gonna blow over because there'll be so much inflation that'll instantly pop up. This is why you've got people like Michael Burry saying we're going to have a second wave of inflation, because everybody knows when the Federal Reserve U-turns, everything's going back to the moon. We're going on the rocket back to the moon. So we have to be at a place where basically inflation gets so stably low that we're fighting deflation to where we can basically give the Fed the license to back down. Now, what are the odds of us actually going to deflation? Well, I actually think quite high. I think when you look at housing inflation and what we've seen with housing inflation, you are on a clear path to massive anchors of owner's equivalent rents, and over 32% of CPI and over 25% of PCE, it's the Fed's preferred inflation gauge, will be plummeting with a massive negative anchor come around June, July. And as long as that also drives down and keeps down other services, which we've already started to see decline in the PPI and retail sales numbers. I mean, when do restaurants go negative? Negative 0.9% month over month? That's over negative 10% retail sales declines for restaurants. It's starting. Like, all of the deflationary numbers are coming. Now we just have to get there. And once we get there, maybe, as long as those inflation expectations break down and we're actually facing deflation, that's when you start getting the pause, the slowdown, the pause, and then you start slowly getting cuts. The only way the Fed goes minus 2% is if something breaks. They don't want that to happen. They don't want anything to break. I think it's raise another 25, maybe 225 BP cycles, pause because the data keeps coming in slow, slowly start coming off. Okay, minus 25, because they don't want inflation to pop up again, right? So they'll really slowly taper down. It's coming. We are probably in 2 or 3 years going to look back at this and go, oh my gosh, we're back at zero. I know that sounds really insane to think about as a possibility, but I believe based on the research that we are conducting with companies, the disinflationary trends we are seeing, the amount of excess capacity that manufacturers have, that servicers have, all this extra hiring companies have done is extra service capacity. And then when all of a sudden demand goes down, we have more service capacity. What are we going to have? Massive deflation in service, in the service sector. We're already seeing it in the goods sector. There's a reason. Okay, look. Yesterday, we talked about ASML in the course member live stream. We did a deep dive on ASML. And one of the big red flags, as a little spoiler here, we do this in the course member live. We try really hard to do a lot of fundamental analysis. Also just, TA, news, everything. But one of the things that we talked about was a risk factor for a company like ASML who supplies chip manufacturing equipment is a lot of the manufacturers bought a lot of extra equipment and they have excess equipment that they are actually not bringing online yet because they don't want to oversupply the chip market. But when demand starts rising, they could go like this and turn on these new machines. And so the amount of rubber band excess capacity that companies have to fulfill demand when it comes back is huge. And in my opinion, it is going to keep inflation down. And as long as the Fed is moderated in their declines, you don't end up getting the Michael Burry second wave of inflation. And you end up getting a stock market that just like goes up like this. And I'm making that face on purpose though. Cause it's like, okay guys, be quiet. Like things are slowly going up. Nobody cheer. Nobody get too excited. Don't wake that guy up, okay? And you get what becomes a Nike swoosh recovery of a 3 or 4 year slow stock market recovery. There'll be some bounces at a U-turn. Hey, come say hi. I'm in a video. You want to say hi?
Hi.
Yeah, this is Jack.
Where do I look?
You look right there in that box right there.
Okay.
What do you want to tell the world?
I like a game in Roblox that's called Base Battles.
Base Battles. Okay. Is it better than Minecraft?
Yeah.
Yeah. What about, is it better than Rust?
No.
That's awesome, dude. Max, you want to come say hi? You generally don't want to be on camera, huh? Can you just scream hi? No? He's just shaking his head. No. I like your shirt though. You got Toad and Mario on there. That's very nice. All right. Well, there you have it. My thesis. I think it is great. Jack, why don't you go ahead and press that red button, press this button right there in 1 sec, and we'll end the video. Thanks so much for watching. Make sure to check out the links down below for that expiring coupon code, and take it away, Jack.